Hello, everyone, and welcome back to another episode. I'm your host, the Millennial Investor, and in today's episode, we're going to go over the performance of dividend stocks compared to your traditional ETFs. We're going to look at some dividend growth ETFs and compare that to some of your top names out there like the S&P 500. A lot of people think that dividend stocks are really boring, they don't really move up in price, but that's not the truth. You can get a lot of growth with dividend stocks. Let's go ahead and look at just some of my performance with some of my positions. Let's look at Broadcom, my largest holdings, for example. I was originally buying Broadcom at $220 a share, and I've averaged up my position all the way up to $345 right here, but today it's almost at $500. So well over my original cost basis. What is that? That's about like a 50% increase or so, and it keeps on going further. If we look at other positions as well, let's look at another high flyer out there. Let's look at like a Home Depot. Recently, I announced that I was buying this company heavily. You see there, March 8th is when I really started buying a lot of this position. It was 261 as my average share price, and I was buying this company back in March, and just since March 8th, when I originally increased my position at $259 a share, it's now over the 300s, and that's just in like 2 or 3 weeks. It is now at an all-time high. It is getting me a great dividend yield. They just raised that dividend 10%, and the share price gains I think of this company long-term is going to be massive, and that's what caused this chart to look like this over a 5-year period. So what we're going to do is we're going to back test portfolio allocations for some high growth dividend ETFs, and then also for just the traditional S&P 500, and talk about the differences between the two. But before we jump into all of that, my name is Jordan. I'm the Millennial Investor. If you haven't seen me before, I own 22 different dividend companies right here, which are listed in column A. We'll be giving an update on some of my information on the next video, like my annual dividend income, my monthly dividend income, my portfolio value, my monthly YouTube income, and I will say out of 3 of these 4 charts, they're all record-breaking months. The annual and monthly dividend income and the portfolio value are all reaching record levels, as you can tell from probably the information right here. But if you look at my portfolio, you'll notice that part of the reason why I've been able to fund my portfolio so aggressively is because of the referrals. Every time you guys get signed up, I get a little bonus, and you guys get a bonus for signing up as well. You either get $10 or $30 just for getting signed up, depending on how much you deposit. If you use my referral link, which is down below in the description, and you deposit $100 to the platform, you get $10. I get $10 as well, and that helps support the channel and get you started with your investing journey. But if you start with $1,000, if you're able to put $1,000 to get started, you will get $30 for getting signed up. So that's a lot of money just to get signed up with the One Finance. $30 is a big head start. I mean, if you put $1,000 in, that's a free 3% return right there. So go ahead and get signed up with that. We've had 103 people sign up so far, and every one of them has loved it. All the features on M1 Finance are free. They have some incredible features on the platform, and it's a company that I 100% stand behind. If you want to see my portfolio firsthand or even invest in it yourself, this is also down below in the description. You can download that link. It'll show all 22 companies that I have and the specific weightings, which are all right here. And there's also other things as well, like you got savings accounts, mentoring calls, credit card referrals. So if you want to check out any of that stuff, go ahead and check it out all down below in the description. But let's go ahead and jump into the dividend ETF that I'll be comparing to the S&P 500. And the name that we'll be using is SCHD. Now, I'll go over some of the holdings in this ETF real quick before we jump into performance metrics. And I want to talk about some of the companies in this ETF. It is very diversified, much like the S&P is. But it basically just takes some of the best performing dividend growth stocks and puts them in an ETF and gets rid of all the growth stocks that do not pay dividends like they have in SPY in the S&P 500. And a lot of these names you'll see overlap with my portfolio. Even though I only own 22 companies, you'll see some of the top holdings I already have. Now their number one position, which is 4.4% of their portfolio, is Home Depot. It's funny because coincidentally, that's about the same target as my portfolio. About 5% of my portfolio is Home Depot as well. Now, Texas Instruments is one that I do not own. It's one that I'm a huge fan of. They also have Amgen at 4%, Cisco at 4%. My number one holding at 4.08%, Broadcom, which in my portfolio is targeted at 9%. Let's see, we also have Pepsi. Let's see, at Pepsi, I also have that as well. One of my favorite holdings, also 5% of my portfolio. IBM. IBM was a company that I've held in the past. It's not one that I'm super excited about owning, but they do have an incredible dividend yield with a great track record of growth. One that I do not own right now, but one that I'm not against a dividend growth investor owning. Pfizer, a great dividend growth company. Merck & Company, one that I have heavily considered in the past. And then another one of my top holdings, we also have Coca-Cola. Coca-Cola is about 4% of my portfolio. So you notice already there's a lot of overlap. A lot of the companies that are in SCHD are already in my portfolio. That's not to say that there's going to be any comparison of performance because there's a lot of differences, but you get the point. If SCHD is doing good, my portfolio will probably be doing good. And on the flip side, if SCHD is doing bad, my portfolio will probably also not be doing so hot. And of all these companies like Home Depot, Texas Instruments, Amgen, Cisco, all of these companies listed, including the 22 that I own, the reason that they're so successful is that they have a track record of raising that dividend at least once a year, if not more. So I want to go ahead and give you an example of this because this is one of the main companies in my portfolio. It's actually tied for my second largest position. And one of the reasons why this company continues to be successful is that not only do they grow revenue, grow profits, increasingly bring value to shareholders, but they constantly raise that dividend a minimum of 4 times a year. And they just raised it again here of March of 2021. They just paid the dividend out yesterday, or I should say they claimed the dividend yesterday, and that marks their 110th increase for the times that this company has raised its dividend since going public back in the 1990s. This company raised its dividend a small amount from 0.2345 to 0.235. It is a small increase, but it is constantly raising, constantly paying out more to shareholders. If we click this little picture right here, this is a photo showing the dividend history for this company from 1994 when they were public. Originally paying out 90 cents a share, they are all the way up to $2 plus, almost to $3 now. So over 3xing that dividend payment just in the last 20 years. But this company has also had massive share performance as well, incredible returns overall if you factor in the high dividend yield, the dividend growth, and more importantly, the share price going up and up over time. That is what causes this company to have dividend growth to look like this chart right here. But if we go back here, let's go to the backtest portfolio because this is what you guys are here for. I want to show the performance metrics for SCHD compared to SPY. Now what we're going to do is we're going to show an initial amount of $10,000. So what if at January 1st of 2020 you put $10,000 in the S&P 500 and you put $10,000 in the SCHD? Well, 1 year ago, I should mention you're not reinvesting, you're not rebalancing. You will reinvest your dividends, but you basically just put that 10 grand in, set up auto invest and set it and forget it. Don't touch it, don't mess with it. January 1st till the day. What will you have? So if we put one portfolio in SCHD and one portfolio in SPY, we'll scroll down and notice the performance metrics. This shows the track record of these two over the last year or so. You notice that SCHD actually performs the SPY, actually performs the S&P 500. A little interesting there. And this is also, once again, remembering a time when all these high-growth tech companies that do not pay dividends, like your Amazons, your Teslas, your Adobes, or your whatever, all these high-growth tech companies are not paying dividends, and they're usually having the best performances, right? A company like Shopify is a company that is like 10x over the last 5 years, but is not included in this growth chart for SCHD, but is for SPY. Now let's back test something else as well, and let's go ahead and go up here and let's look at 3 years out. Just curious, let's look at how this looks 3 years out into the future. And okay, here we go. Let's look at the chart here. Now, to be fair, they're almost dead even, and it's honestly not any type of like massive difference. But you notice that SCHD actually performs SPY once again on a 3-year metric. It's a little shocking to see that this ETF is actually performing the SPY, which is supposed to have better growth. Because this is where we're talking about capital appreciation does not always outdo dividends. And this is one of the biggest roaring bull markets that this economy has ever seen. This is a 10-year plus bull market, and this is when growth stocks are really starting to outshine the boring dividend stocks. So if it's this close, it's pretty interesting to see during a time when the bull market is roaring. Let's go out further and let's look at a 5-year period, okay? Let's go back to 2016. Let's go ahead and click Analyze Portfolio. Let's scroll down once again, all of the portfolio in one, all of the portfolio in the other. And the portfolio difference is actually starting to get a little bit drastic. You can see SCHD outperforming SPY. And then let's look even further out. Let's look on a 10-year metric. And then on a 10-year metric, for the first time on these charts, as we get further and further out, as we get a decade into the past, this is the first time that SPY actually starts to outpace SCHD. And that is mostly because, once again, these roaring tech stocks. And as you look at this, generally speaking, you notice that the dividend stocks outperformed the SPY when they're generally not supposed to like people tell you. But the one thing that's not mentioned in this, okay, if we just look at the total value of the portfolio, this really just gives you an idea of what growth will look like. Because with growth in bull markets, it typically performs a lot better. And then once again, in bear markets, dividend stocks will typically perform a lot better than growth stocks will. But one of the things that I think that should be taken into account here is portfolio income. What I didn't show on these graphs was the portfolio income. So let's go ahead and look at like a 5-year difference. Let's look at the 5-year charts real quick, and then we'll look at the 10-year. On a 5-year return, let's look at the dividend income, the portfolio income over a 5-year period. You can see that SPY does not perform nearly as good as SCHD when you're talking about return capital to shareholders. In terms of returning capital to shareholders, this chart gets more drastic and drastic. Originally in 2016, when you first started investing, SCHD is a little bit above it, and you see at these levels, it's now doubling what it did for SCHD than it did for SPY. SPY, the S&P 500, only returned $300, while SCHD would return $600 on a $10,000 investment. And then let's look on a 10-year chart, and that's when things really start to get drastically different. From 2011 to 2021, investing $10,000 in SCHD or the S&P 500, the portfolio income is drastically different. Once again, starting out pretty similar, and then they spread out a little further, a little further, a little further, and then we get to 2020. 2021 obviously hasn't finished yet, but 2020, you had $536 coming from the S&P 500, but $992, almost double, coming in 2020 from SCHD. And this factors a long track record, okay? This factors in the tail end, coming out the tail end of the recession, of the Great Recession in 2008, 2009. This factors in the coronavirus that happened in 2020. This factors dividends being raised. This factors in dividends being cut. And so many things changing over the last decade. But you can see, as far as total return goes, it's pretty similar, okay? And I think in a lot of different metrics and a lot of different markets, it will differ. But generally speaking, these two overlap each other a lot, and they will have similar returns. But if you look at the difference in dividend yield, if you ever need to take money out of your portfolio, whether you have an emergency like getting laid off, like what happened in 2020 with shutdowns, or if you ever just want to fund your lifestyle, if you ever just want to take money out of your portfolio to enjoy your life, then this is what you want to look for. You want to look for SCHD because this will fund your portfolio for life. But this is what I talk about, guys, why I love dividend investing. There's definitely opportunities with growth stocks out there. That's not what I'm saying whatsoever. And if you put your money in index, you'll be just fine. And in a lot of ways, it's one of my top recommendations. But as far as portfolio income and taking money out of your portfolio, this is why I love dividend stocks, constantly returning capital back to shareholders, providing opportunities for shareholders to not only put money into their investments and watch them grow, but giving them opportunities to take them out. So this is why I love dividend investing. This is why I'm implementing this strategy myself, and this is why all 22 companies that I own constantly raise that dividend at least one time a year or more. But thank you guys so much for watching. This was just a quick little fun video comparing performance metrics. But like I said, if you want to get signed up with anything down below, like with a mentoring call, if you want to speak directly with me, if you want to get signed up with M1 Finance, credit card referrals, all that stuff, check that out down below in the description. But I thank you guys for watching all the way to the end, and I'll catch you guys next time.